This lesson covers profitability ratios used in corporate finance. The profitability ratios that will be covered include profit margin, EBITDA margin, return on assets, return on equity, and the Dupont Identity. Profit margin is the first profitability ratio that is used. And to calculate profit margin, it's simply looking at the net income for a company, and you're going to divide it by the sales. So you go to your financial statements, find the net income, divide it by the sales. So what does a profit margin mean? It actually tells us how well a company is handling its finances. So this is the money that is the profit that is left over that they get from the net income when you divide it by all of the sales. The next profitability ratio is the EBITDA margin. Now remember that EBITDA stands for earnings before interest, taxes, depreciation, amortization margin. So to calculate the EBITDA margin, you find the EBITDA, so you'll have to look for that line specifically, and divide it by sales. So what does the EBITDA margin tell us? It tells us it measures the before tax operating cash flows. The next ratio is the return on assets, also abbreviated as ROA. So to calculate the return on assets, we are going to look at our net income divided by our total assets. So you do once again have to go to the financial statements and look at the individual lines for net income divided by total assets. So what does the return on assets mean? It's basically, it measures the profit per dollar of our assets. After calculating return on assets, we are now moving on to return on equity, also abbreviated as ROE. So to calculate the return on equity, you look for the net income and you divide it by the total equity. And so what does the ROE measure? It measures how stockholders did during the year. And you may be wondering, well, why is that important? Well, remember that in the corporate finance world, the goal of corporate finance and taking on additional projects and such is to increase the value of the firm. And one way to measure that is by how much money the stockholders earn through their ownership of common stock. So once again, the ROE measures how the stockholders did during the year. So the next item to look at is the Dupont Identity. Now this isn't a new profitability ratio, but rather it takes the other ratios and it combines them and does a little bit of math tweaking to come up with a different way to calculate the return on equity. So as you can see, we have, for this Dupont Identity, we have the return on equity as the net income divided by sales, multiplied by sales divided by assets, multiplied by assets divided by total equity. You'll notice that the first net income divided by sales is actually an operating efficiency measure. You have sales divided by assets. That's actually your asset turnover ratio. And then the third equation, assets divided by total equity, that's your equity multiplier. So when you're looking at this, we see the sales on the bottom. We also see sales on the top for the asset turnover ratio. So you would actually cancel those out. And then we move on to the middle of the asset turnover ratio, and we would look at our assets on the bottom, and you would counter that, mark that out with the assets on the top, the numerator of our equity multiplier. So that leaves us, when you look at the total equation, with net income divided by total equity, which is once again our return on equity formula. And so you may be wondering, okay, I don't understand, why are we looking at 3 different calculations when we can just look at one for the return on equity? Well, what this Dupont identity does is it allows us to look at specifically what's behind the return on equity and gives us a little bit more information. So instead of using the one equation, we have 3 different equations. So as we know, the first one, the profit margin, that's going to look at how the company is operating efficiently. And then the second equation, the sales divided by assets, is our total asset turnover. So then that's going to take a look at the asset efficiency portion of this. And then the third equation, assets divided by total equity, which is also the equity multiplier, this is going to look at any financial leverage. So we can look at when the return on equity goes up or down or how it's performing. We can now take a deeper dive into the 3 different areas here and these 3 different formulas to figure out what is controlling or what is manipulating and changing the return on equity, just to get some more additional insight. So that concludes the main profitability ratios when looking in corporate finance. And once again, just to summarize, we looked at our profit margin, we looked at our EBITDA margin, we looked at our return on assets, we looked at the return on equity, and we put some of those together to get our Dupont identity. Thank you.